So Paul, welcome. Happy to have you on. We were just chit-chatting about, you said you've recently stepped away from, you're in a transition period with your firm or something like that after building it up after over 30 years in the investment game.
Yeah, so I worked for a big mutual fund company here in Canada called Mackenzie Investments. So I worked there from 2000 to 2023. So, 23 years. And yeah, it was a great job. Really enjoyed it, but wanted to step back. My team was ready to take over. That's one of the issues of developing a good succession plan is you succession yourself out of a job, but I wanted to focus more on communication, which we'll talk about, and focus on my book and my free blog. But I still have a relationship with my former employer, and I'm doing this podcast from my old office. So
yeah, we were chatting. You said you have a place down in Florida, and I was like, that's where you need to be right now because it's a little chilly up in the north.
Well, I live in Mississauga, which is a suburb of Toronto, but I'm in downtown right now. But yeah, we go down to Florida a lot. We have a place there. My mom lives next door, and our eldest daughter lives down in Palm Beach Gardens area. So we go down a lot. It's a great place, yeah. and warmer.
Yeah, Al Capone would definitely be down in Florida during the winter months to escape the frigid winds of Chicago back in the day.
Yeah.
So yeah, it's definitely good. So you created such a good succession plan that now you're just working on some other things. But leading up to this point, what was your motivation in terms of building this out? Because the investment game isn't as fast or as luxurious as people might see in Hollywood, the movies like Wolf of Wall Street or Margin Call or The Big Short. It's definitely not as theatrical as that.
Yeah, well, no, the vast majority of the investment industry is not. I would imagine that there are some aspects that might be like that. That's not what we did. The investment industry and the finance industry, of course, is a very broad industry. There's many different aspects to it. And our investment style was the antithesis of what you would see on Wolf of Wall Street. And I absolutely loved it. There would be days where I wouldn't talk to a single soul. Just come into my office, close the door, and open a new annual report from a company that I was starting to research. See, can I figure out this company? Can I figure out what makes this company so special? And so you're reading the narrative, you're going through the accounting, you're doing some forensic accounting, making sure that there's nothing untowards there, or are there any secrets in the accounting that you can find? And sleuth detective type work. And, then you get to go and meet the companies and stuff like that. But most of your time is spent on your own thinking, analyzing, building your model. And yeah, it was such an amazing job. But, you would talk to people from time to time, but not a hell of a lot, which was fine with me.
Yeah. So we're in this similar space. So what aspect of the business were you in? It doesn't sound like you were too client facing. Was it a fund that you were running? Was it a family office? Walk the viewers through that so they know the difference, because the financial space can be confusing. You got insurance agents claiming to be, wealth consultants, and there's a lot of confusion out in the world.
Yeah. So I was a portfolio manager for mutual funds. So I started off as an analyst and then became portfolio manager, and then I became head of the team. And what you're doing is you're looking around the world for what you think are our style anyways, our investment style, for what we thought were some of the best run businesses, and determine whether or not it was a great business, and then determine whether or not its share price was attractively priced. Were two very important parts of the investment process. Can't have one without the other. And so you spend your time just doing analysis and then talking with your colleagues as well, and about what you think the competitive advantage is, why you think it's sustainable, what the risks are, what do you think about the balance sheet and all that kind of stuff. But there was a lot of, especially as you progress in your career, you do a lot more client-facing type meetings because you're running a business. It's not enough just to generate decent performance. You have to be able to explain to your clients, A, how you did that, and B, why you think it's sustainable. So your clients have to really have confidence that what you did in the past is a close approximation of what to expect in the future. And they will only have that confidence if you're able to clearly enunciate and explain in can demonstrate what your investment process is step by step. Yes, this makes sense. And we don't know, nobody knows what the future holds in terms of the path of the economy or interest rates or stock markets. There are lots of opinions out there, and a lot of people think they do know, but they don't. It might happen as they say, but they just get lucky. It's not that they're stupid. They're educated guesses, but they're still guesses. And so our style was to put together a portfolio that would do well in most economic environments. Mm-hmm. And if it was a really bad one, yes, we would go down, but not as much as others. The one thing that does hurt you with that approach is if the markets are soaring, we're not going to soar with them. We're only going to be doing this. So we're going to be trailing, but we're still doing well, getting our clients closer to their long-term financial goals. And they're okay with that as long as you've carefully explained that before they invest. So it's a multifaceted job, the analysis, the marketing, the education, educating the clients, educating your wholesalers, educating even your boss, because your boss will be overlooking different mutual funds with different investment styles. So you have to make sure they clearly understand what your style is and building relationships and whatnot. So it's a long-term thing for sure, but I absolutely loved it. So it never felt like work,
Yeah. I mean, I started out as like a financial advisor, and then I didn't realize that financial advisors don't know anything about investment strategy. They just know about accounts, finding people, harvesting assets. And that's typically where the relationship ends. So I've definitely taken the path now to escape that so I could focus on what I think is fun, which is the building and, the testing of like, hey, how well can you figure things out? And then will your thesis hold up? Depending on what happens, which is out of your control, because you can make the best investment decisions and the best investors in the world make mistakes. However, there's a difference between fatal and just like a flesh wound with investing. If you put your 100% in and you're wrong and you lose 50% of your capital, that could be devastating. But if you limit the risk and you only do 10% and you lose 50%, you're only down 5% and you can recover from those sort of things. So it sounds like those are the sort of things that you were mentioning through your analysis.
Exactly. And our clients were financial advisors and planners, brokers, whatever.
Oh, so your clients were the financial advisors. So the financial advisors are like, we're firing this person and we're going with Paul's fund because of XYZ.
Yeah. Or we're firing you and going with somebody,
Yeah. Everyone gets fired.
Everyone gets fired. And so we had advisors who, for the most part, tended to be more conservative. And our clients, we had some extremely sophisticated financial advisors who really knew their stuff. Yeah, and a number of them actually over the years became friends and are still friends to this day. I have a free blog. It's called instead of Political Economy, it's Political Economy, my name. Your listeners can sign up for it. It's free. A number of them still receive that on a weekly basis, and I still hear from them. So it's great. When you can build relationships that are based on respect and based on trust and based on sort of aligned interests, which ultimately was getting our financial advisors' clients to their long-term financial goals. Because the advisors' clients are the ones who are paying all of us. They're paying everybody. Right. So we all need to be working our asses off to make sure we're doing the right thing by them. And so very important never to lose sight of that. And it can be quite a fulfilling way to earn a living. So I was very fortunate.
Yeah. I mean, last year I helped 2 folks get over the $1 million investable assets mark. So that's fun. I enjoy the building. The building's the fun part. The end part is more legal, protection, a little dim because you're talking about, legacy and things like that. But in terms of like what you're doing now, what's your motivation with this blog? Because you don't really need to do it, but it seems like you have some sort of meaning behind this.
Yeah. So over the years, my great passion, I still love investing, but increasingly my passion became clear communication. education. And the reason is not just for the hell of it. You can see the impact that you can have on people's lives, on their business, on their confidence, on their understanding. It's empowering. So when I used to talk about our investment style and what was going on in the economy, which we can talk about, I would do so in very easy to understand terms. My goal was never to impress people, but to empower people. And then our clients, our advisors, could go to their clients and very easily and clearly repeat the story and then give their clients confidence to keep their money with those advisors. And then our advisors gives them confidence to keep their money with us. And then we all sort of march forward based on how we said we were going to do things. And, with few surprises. There's no such thing as no surprises in the investment industry. It's a very humbling industry. And so over time, communication and thinking extremely carefully about it. And it's not easy to come up with like good analogies. I've heard lots of bad analogies over the years.
Like what?
It was an economist who was saying that, so my belief is that when you have a recession, it's usually a result of bad economic policy that led to the recession. So usually it's monetary policy that is too loose for too long, like the housing bubble in the early 2000s, where the Federal Reserve kept interest rates far too low to drive housing prices higher because they thought it would be good for the economy. It's not. It's only good for those who own houses, which again, we can talk about. And then the whole thing crashed. And so, of course, the Fed came running in and bailed out all the bad decision making. And when you have a recession, the recession is the economy trying to heal itself. It's not a punishment. It's an economy trying to heal itself. And if you forestall the healing by taking interest rates to zero and printing trillions of dollars, all you do is paper over the problem. The problems are still there, festering, and will resurface somewhere down the line. Just because you've driven stock markets higher and housing prices higher doesn't mean that the underlying issue has gone away. It hasn't. It's just getting worse. And so you want to get rid of companies that are misallocating capital. And I'm going to answer your question about the bad analogy in a second. So when you take interest rates down to zero, what happens is you end up with what's called zombie companies. So a zombie company.
Oh, yeah. Coca-Cola does that. They talk about zombies.
Oh, do they?
Yeah.
So zombie companies is a company that doesn't generate enough operating profit to even pay the interest expense on their debt. And back in the early 80s, it was maybe about 2 or 3% of companies in developed economies, listed companies, were zombies. Pre-COVID, it got up to about 17 or 18%. So it increased significantly. So that many more companies out there destroying capital. They're not putting capital to productive use. And so you saw productivity growth declining over the years. So this is a really bad thing. So a recession helps get rid of those companies because they can't get access to more capital in order to destroy it, right? But central banks forestall that and give these companies more capital so they can continue to destroy capital. So this one economist said, well, allowing bad companies to go out of business is kind of like saying that a plague is a good thing to clean up the gene pool. So that's a really bad analogy because it's nowhere near the same thing. Effectively, what he's saying is just because we want to save people from a plague, then that means we have to bail out Wall Street. That's not a good analogy. So, sorry, it was a long way of telling you what the bad analogy was. But it's not easy to come up with a good analogy. Now, some people purposely come up with bad analogies, but those analogies are confusing and make people at first blush think that there's something to it.
Yeah.
And this is based on what's called normative economics or economic laws or rules as people want them to be and would like them to be rather than as they really are, because the economic laws are very inconvenient. It's like the law of gravity. And some have used this analogy where, some like economists getting angry at the law of economics is like people getting angry at the law of gravity for plane crashes, blaming gravity for plane crashes. There's nothing we can do about the law of it is you can't change that. right? Don't get angry at it. But this is what people do in economics, and then put forward all kinds of complicated formulas and equations to convince politicians that there is such thing as a free lunch. There isn't. You cannot get something for nothing. If you take out from the system more than you put in, it comes at somebody else's expense. And it's not the government. The government does not produce anything. Everything is produced in the private sector. The government has a very important role to play. And there are lots of hardworking people at the government. There's a lot of not hardworking people at the government too. But there are a lot of really good, smart, hardworking people in government. But the government, just like the finance industry, both government and finance, play primarily a facilitator role. We facilitate the production of capital in the private sector. But what's happened over the last number of decades is government and finance continue to grow as a percentage of the economy. And so the real economy, where all the stuff is being produced, has to work that much harder to pay us, the facilitators. It should be the opposite. Our facilitator role, our percentage, our size of the economy should be shrinking due to investment, technology, greater efficiency, productivity, stuff like that. And so we are becoming like this weight on the back of the real economy. And life is getting more and more difficult for more and more people, particularly in the bottom half. Well, not particularly, in the bottom half. The top half are probably doing okay.
Yeah, I've thought of like how the economy is right now. It's like LinkedIn. It's been a lot of business to business, keeping it moving.
Yeah, no, you're absolutely right. Yeah.
In terms of like recession, I always think about it like we all know someone who like cheated or like took a shortcut and they were cool in the moment. And then you ran into that person 10 years later and you're like, okay, it finally caught up to you sort of deal. So sometimes you have to be willing to give up those investment returns today so that you're further protected in the future. And I know Warren Buffett has written about it in letters, like their goal in the bad markets is to outperform and then deploy capital smartly, which right now they are positioned to do that whenever they want to.
Well, no, exactly. But again, central banks, particularly with Ben Bernanke after the great financial crisis, changed all that. I mean, it's not all gone, but a lot of it has changed because investors know that if they take on a lot of risk and buy overpriced basket case companies and the market starts to go down, the Federal Reserve will come storming back with trillions of dollars of QE to bail out investors. When you bail out investors, you further and further distort the price discovery mechanism of capital markets. Capital markets are there. They're there to allocate scarce resources, to allocate people's capital that they've created, allocate it around the world, around the country to the best utilizers of that capital. That's the role of stock market. The role of stock market is not to provide someone with a retirement income. That's a consequence of all of this, of allocating capital. But when you, again, distort the price discovery mechanism, you harm the markets or the economy's ability to generate capital. And so today, there's far less capital being produced in the economy than there otherwise would have been. It's still growing, but it's growing much slower than it would have otherwise have grown if central banks hadn't interfered with all of this. Now, it's not a conspiracy theory. I'm not saying that central banks deliberately did this in order to make the wealthy even wealthier at the expense of everybody else, because we have seen that wealth inequality has been widening. There should be wealth inequality based on ability and efforts and success, all that kind of stuff. And it's probably always too wide, but I don't think people mind so much as long as they feel they're getting a fair shake. But now it's been widening to grotesque levels. And it's widening to grotesque levels, not because all of a sudden the people at the top became that much smarter or worked that much harder or that much more successful. No, the Fed drove their asset prices that much higher. And so people don't like it, and it's not fair, and it's not sustainable. And so it will end. And I wrote my book. So my book is called Capital Offense, Why Some Benefit at Your Expense, which was just published this year. And I wrote it, like I was talking about earlier, in very easy to understand terms to empower people and to educate people with respect to what's actually going on, why they feel that despite the fact that I'm better educated than my parents and I'm willing to work just as hard, I can't even dream of affording the same sort of lifestyle that they had, particularly when it comes to housing. So with this book, my hope and my free blog, my hope is that I can empower people with understanding and truth, and such that the people can demand different decision making from policymakers. There's an old saying that the people always get the government that they deserve, i.e., you voted for them, so stop complaining. Well, that's only true if the people really understand what's going on. But in terms of how an economy works, what money really represents, a lot of people don't understand. A lot of politicians don't understand. Again, they're not bad people. They think they're doing the right thing. Central banks thought they were doing the right thing by driving asset prices higher, that it would drag the economy up with it. No, asset prices should be going higher if the economy is growing and the capital being produced is growing, and that pushes stock markets higher. You don't push stock markets higher to try and pull the economy up. It has the opposite effect, because by pushing stock markets higher, as I said, you harm the price discovery mechanism, and it makes the economy grow less quickly. And so if people understand what's going on, then they will demand that central banks stop driving asset prices higher, will demand that governments be more responsible with the budget and don't spend so much more than you take in taxation, don't have taxation that's so high, get the debt in order. And when you do all that, the economy will start to thrive. And policymakers will make these decisions if people demand it, because that's how you stay in power. And they'll want to do it. They want to do the right thing. I truly believe that. But nobody's demanding that of them because nobody knows what the right thing to demand is.
So who knows what the right thing to do is?
Well, I do. The solution is not a painless one. And, some people would benefit right away, but many more, I think, would be harmed with the solution. The solution is to get central banks out of capital markets, get them out of the housing market, which means that if investors no longer believe that the Federal Reserve will come to their rescue and print trillions of dollars, that they will start being more careful with respect to what they invest in, will be more careful with respect to valuation, and stock prices will start to come down. If you get them out of the housing market, stop buying mortgage-backed securities to drive 30-year mortgage rates down to historic low levels. I know they've stopped doing it recently, but they could come storming back again. If 30-year mortgage rates are at natural levels, then the house of prices wouldn't necessarily come down, or the price of houses would necessarily come down. A lot of young people, they can't even dream of affording the same sort of lifestyle that I have had. I'm 63. Actually, 64 tomorrow. So,
happy almost birthday.
Yeah,
do you think that's a mindset issue or like a real issue in terms of being able to live the same lifestyle?
Well, it's a real issue. Inflation is higher than the official numbers will tell you, but I think that's always been the case. But particularly in terms of house price to income is a lot higher today than it was in prior decades. So, and this is a fact. And now, in prior decades, like the 50s, 60s, 70s, maybe even 80s, houses might have been a bit smaller. So houses have gotten a bit bigger. So you say you get more house for your buck. That's true. Although over the last 25 years, housing size has hardly changed, up a little. They've started to decrease recently, but there's not much change. So if you just focus on the last 25 years, houses are pretty much the same thing. Others will tell you that, they don't make houses like they used to, So it depends. Anyways, so a house should not be increasing in price because a house is not a productive asset. So in a free market capitalist system, you should only be benefiting financially or from a capital perspective. You should only be benefiting to the extent that someone else is benefiting from your efforts. It's a mutual benefit system. And there are rules, but a lot of the rules have been broken over the last 25, 30 years. That's why it's not working anymore. So for instance, and again, people have to differentiate between capital and money, and I'll get into housing in a second. So capital and money are not the same thing. So capital is what makes the world go around, not money. Money is extremely important, and we couldn't have an economy without it. But capital is what people need in their lives. So capital is anything you produce, like a good or a service. So if, let's say you make a bike, I make a suit, and let's say there's no money in the economy, then you and I would do barter, or what's called direct exchange. I would give you my suit in return for your bike. So think about that for a second. There was no bike and no suit in the economy. You created a bike, I created a suit, and we swapped it, and it didn't come at anybody else's expense. No one was harmed by that capital creation and that transaction. That is the way it's supposed to work. But we don't do direct exchange. We do indirect exchange through what's called the medium of exchange, which is called money. So we use money to exchange all the capital that we're all producing. Billions of people around the world every day producing capital. The money is just there to exchange that stuff that's being produced. So if you double the money supply, it doesn't increase the amount of capital that's being produced. It just doubles the prices for everything that's being produced, right? So you have to differentiate between the two. Now, the example I like to use, let's say you make 10 bikes and you sell them for $1,000 each, right? Bikes. So you got $10,000. You put it in your bank account. What that $10,000 in your bank account represents is the 10 bikes that you produced. So when you go and spend that $10,000, what gave you the wherewithal to demand something worth $10,000 was the fact that you produced 10 bikes. The production of the bikes gave you the wherewithal to go out there and demand something from someone else. But instead of going shopping with your 10 bikes, you sell your 10 bikes and you're effectively storing up those 10 bikes in that $10,000. So your $10,000 is acting as a temporary store of value for your 10 bikes. Okay. So now you decide, well, I don't want to spend my $10,000 right away. I'm going to wait until the end of the year and I'm going to go on a nice vacation. But before you get a chance to spend your $10,000, a central bank doubles the money supply. Now, when a central bank doubles the money supply, they just print it out of thin air or digitally press a few buttons. They did not have to create any capital to obtain that money. So that newly printed money doesn't store any capital, but it obtains capital as soon as it comes into the economy by extracting capital from the rest of the money that's already in existence. So as soon as that new money comes into the economy, it extracts 5 of the bikes from your $10,000 and puts it into the new money. And so your bank statement still says that you have $10,000 in your bank account. But instead of temporarily storing 10 bikes, it's now only temporarily storing 5 bikes. And so now your $10,000 will only buy half as much as it would have done before the central bank doubled the money supply. So now only your wife can go on the vacation. You have to stay at home, right? So now a house is not a productive asset. It's more of a consumption asset. So we live in a suburb of Toronto and we bought our house in 2001. Just when the U.S. Federal Reserve started this housing wealth effect policy. And so we just got very fortunate that mortgage rates went through the floor and resulted in rampant demand for housing, which drove the prices of houses higher. So our house today, we could sell it for 4 times what we paid for it. So now remember earlier, I said that in a free market capitalist system, if it's operating properly, you should not be able to take out more than you put in. Whatever wealth you have should be a reflection of the wealth that you've created and somebody else is benefiting from. So if I've got 10 bikes that you created, somewhere out there, someone else has 10 suits that I created. That's how I got those bikes. It didn't come at somebody else's expense. But if my house quadruples in price and I get all this extra wealth, what was my contribution to society? Who out there also has 4 times what my house was worth? Nobody. But it's even worse than nobody having 4 times that wealth, is that others have 4 times less wealth because the wealth I have came at their expense. I effectively took it from them. So when you look down on society, so my house is not producing 4 times as much stuff. It hasn't grown 4 times in size. It hasn't relocated to a location that's 4 times nicer. No, it's the same economic good that because of central bank policy and other things that drove housing prices higher, which we could talk about, all these actions force younger people or newcomers, immigrants to our country, to pay 4 times what we paid for the same economic good. And so if you look, and I mean, it's getting worse in the US. It's way worse here in Canada and in Australia. So for instance, for years, you're asking whether it's real. It's real. So for years in Canada, in the 70s, 80s, 90s, the average price of a home to the average after-tax income, usually was ranged from 6 to 8 times. So let's say an average of 7. Starting in 2001 with the central bank policies, because the Bank of Canada followed the US Federal Reserve, along with the Bank of England and the European Central Bank, etc. They all did the same thing. Starting in 2001, house prices as a percentage of average after-tax income started to rise significantly. So they went from an average of 7 to today, we're at around 12 times. So it takes that much longer for a younger couple to save up, first of all, for the down payment. And second of all, they pay a lot more in interest expense over the term of the mortgage because they're paying such higher prices for the homes. And so, yeah, so you're seeing, I think the average age of the first time home buyer in the States is something like 40 years old now or something like that. It used to be like late 20s or something. And there are societal changes, of course, that changes over time and people make different decisions. People have decided to have work longer maybe before they have kids. And so I'm sure that contributes to it. But I think the main issue is the fact that people just can't afford it when they're in their 20s. They have to work that much longer to afford a home before they can start a family. And yeah, so again, I just think it's really good intentions by policymakers that went really bad. And because there's no easy way to fix it, nobody wants to take the necessary and obvious actions that would fix it. And another example is Social Security in the US. By 2034, it will be insolvent on a current path in terms of the benefits that are paid and how it's indexed to inflation and the amount that people contribute. So I think it's like 6.5% of your paycheck goes into Social Security. Your employer also pays 6.5%. And so it will be insolvent in 9 years. And I forget what by law, the benefit cut would be, but it's significant, like a 23% cut or something. And so that's going to happen. Not the cut necessarily, but it will be insolvent. So something is going to change between now and then. But nobody wants to make the decision because it's political suicide. Because both parties, all this stuff, by the way, transcends politics. Both sides, Democrats, Republicans, well-meaning but culpable, and refusing to deal with the issue because it's political suicide in order to do so and it's their own fault because they have convinced people that this is all affordable. I wish it was. I wish people could have $1 million in Social Security every year, but somebody's got to pay for it. And so it's not about demonizing people. I believe the vast majority of people are good people and want to do the right thing. And I believe as well, the vast majority of people are very smart people, particularly when it comes to what to do with their own hard-earned capital, with their own skin in the game. They don't need policymakers or politicians telling them that stocks are cheap or that stocks are expensive or that houses are cheap. No, people are smart enough to figure out what's good value for themselves, particularly when it comes to housing. People will buy expensive housing, not because they think it's good value. The only reason they will do that is because they expect it to be even stupider expensive in the future and they can sell it to some sucker, right?
Yeah.
And yeah, so yeah, my book is not about, again, it's not about trying to demonize. It's not a vindictive type book, I mean, at times I might sound angry, but, I offer solutions at the end. And even those who got us into this, I think could help get us out. And so I am optimistic, but it won't be without pain. And I have an analogy. I use this with my clients for many years, and I put it in a book. Dealing with the situation will be painful. But it would be like if you went to the doctor and the doctor said, okay, look, you've got this tumor. And if you don't operate on a tumor, you're going to die. So I can operate and I can save you. But serious surgery, serious rehab, you're not going to be able to work for 18 months. So it's like there's an 18-month recession. But this is what's required to fix you. Again, is the doctor punishing the patient by, doing the surgery and they can't work for 18 months? No, they're trying to heal the patient. And, so they're about to, you agree that, yeah, okay, let's go through this and it will be contagion. My family is going to suffer as well. It's no fault of their own. But they're about to will you into surgery, and then a central banker doctor walks in, and instead of surgery, he or she recommends these magic QE pills. And you take one of these pills and you're going to feel like $1 million the next day, right? You just print money and right away stock markets and housing prices start going north. And so you take one of their pills and you do feel like $1 million the very next day. And so now you're angry at me, the doctor that was prescribing the removal of the tumor, because now with these magic pills, you don't have to go through that 18 months of rehab.
Yeah, we're starting to see that with the GLP-1s.
Yeah, no, exactly. And then, so you go back to work and making more money than ever and bigger house, new friends, everything's hunky-dory. But 9 months later, all of a sudden, you don't feel so good. Go back to the first doctor and the diagnosis is, well, not only is the tumor still there, but it's bigger and I can still save you. But instead of 18 months of rehab, it's now 3 years of rehab. So the consequences now of doing the right thing are that much more severe, which makes it that much more difficult for policymakers to make the right decision. And so you kick yourself, like you knew that you should have had the surgery 18 months prior, but you let some smooth talking central banker doctor convince you that you were special, that you could get away with this, that you were entitled to not have to go through this rough period. And so, okay, well, let's deal with it now. Then they come with the QE2 pills, and then they come with the QE3 pills. The pills, the printing of the money, the driving the asset prices higher is dealing with symptoms of asset prices rather than the fundamental health of the economy, which is the efficient allocation of capital through capital markets and an undistorted, unhampered price discovery mechanism. And so, as I like to say, central banks around the world, by the way, led by the Fed, they have sacrificed the mainstream economy on the altar of higher asset prices. And it's not going to end well, with the rich getting richer. And again, the rich haven't done anything wrong. Like they've played by all the rules and and it would be wealthy regardless, but they're significantly more wealthy than it would have been. And, if we don't change it, we'll either end up with a sort of flat socialist type economy, socialism, where everybody's wealth is lower than it is today. Even the bottom quintile it'll be a lot more even, but everybody will be lower. Or you end up in a situation like that movie, The Hunger Games, where you have the ultra rich and they increasingly have to protect themselves in gated communities and because people are getting angry and they want a fair shake and they should be angry and they do deserve a fair shake. And my book is an attempt to help with the understanding with respect to what's going on so we can move forward in a constructive manner, if not painful. And the thing I love about America is that once you guys decide to do something, boy, you guys can do it. And it's just amazing. But people will only agree to do it if they believe and trust that you're all in it together, that it's not just me that needs to make the sacrifice. They're going to be fine and dandy and they're going to still be doing well. No, they need to know that your neighbors, everybody's in this together. And then I think it can happen.
So what's the good part about all this? There's got to be some sort of silver lining that you believe in.
Well, that's it, I'm afraid, that more opportunity for more people. As I said earlier, I do think the average person is very smart, but not enough very smart people get an opportunity to contribute. And there are a lot of people out there trying to make that happen. But if there should not be equality of outcomes, because outcomes depend on effort and ability and all that kind of stuff, but there should be equality of opportunity. And if there's more opportunity for more people, the world would be a much better place. We would all benefit from that because there'd be more people contributing, more capital being produced. And then another good thing is that the younger generation could, the average age of the first time home buyer in the US would start coming down again, which I think is a very good thing. I think people will be less angry at each other. I think that's a very good thing. I think that the US is very divided today, primarily, this is my own theory, primarily because people know that they're struggling, but they don't know why. I think it's because of all this that I've just talked about. It's hard for people to connect the dots. And so then because people don't understand why they're struggling and why some others seem to be doing fine, it's human nature to look for someone to blame because you went to school, you studied, you work hard, blah, 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 you're honest, still not working for me. And so you look for someone to blame. And then I think it's very natural that Republicans would blame Democrats and Democrats would blame Republicans. And there's always been that divide, but it's a question of degree. And, as mentioned, I've got a place in Florida. We go down there a lot. And we have a lot of friends down there on both sides, Republicans and Democrats. And they're all beautiful people. They agree, if they talk to each other, they would agree probably on 95% of things, But this system, I think, bad systems, bad environments bring out the worst in very good people and vice versa. And so I think that would bring people together. I think that's another good thing. And then finally, I think that people's wealth, their material wealth, would be a closer approximation of what their actual contributions were to society. That's where we need to get to. And that primarily happens, I think, for most of us, but not for enough. There are some who don't get nearly as much as they deserve, as much as their contributions are, and others who take out far more. I just think it would be an amazing thing. But there's no painless way of getting there. There's another saying. It's called the rule of holes. So if you find yourself in a hole, the first rule is to stop digging. We've been in a hole for a long time, and rather than stop, we've dug faster and faster, which makes it increasingly difficult to get out of that hole. We can still do it, but the longer we delay, it's going to become even more difficult to get out.
Well, we need some rain to fill up the hole so we can swim to the top.
Yeah, or drown.
Well, hopefully you know how to swim, you can swim to the top, unless you can't make it. It depends how deep the hole is, but that was my initial thought. Fill it with water and swim to the top.
It's good because that is what policymakers will often rely on. Hope for that something will come out of left field to bail us out of having to make the right and painful decision. So they keep, as I say, kicking the can down the road. Something will come along to save us. And hopium, some people call it, like wishful thinking is not a very good strategy. Don't get me wrong, it's possible. Something it would be miraculous. It would be like a miracle. But that's what politicians will point to rather than do what's necessary.
Yeah, well, sounds like everyone needs to figure out how to be productive rather than, try and just take.
Well, yeah, and as I said earlier, Josh, like those who are just taking, for the most part, don't even realize that's what they're doing. And they're all good people. So like people my age, when I explain to them that when they make so much money on their home, oh, and by the way, like when you guys make money on your home, up to a certain amount, it's tax-free, right? But then over a certain amount, you have to start paying taxes. Canada, there's no limit. So if you make $20 million on your home, it's all tax-free.
Oh, wow.
Same thing in Australia. So, but when I explain to people my age that, don't take this the wrong way, but I know you made a lot of money on your home, so did I, but neither of us deserved it. And it comes at someone else's expense. Now, initially, they don't like hearing that. But then I emphasize that, look, you haven't done anything wrong. You haven't broken any rules. You did everything you were supposed to do, but it comes at somebody else's expense. And that only happens because of central bank policy. And so I don't want to sort of demonize anybody here, even central bankers who thought they were doing the right thing. It's not about that. It's just opening people's eyes and demanding change. And change is coming. Change is coming. It's up to us to decide how that change happens. Either we change it ourselves in a controlled implosion, like when you, for a demolition job on a tall building, you explode or implode it and it comes down controlled, or you have an out of control explosion, there would be lots of collateral damage.
Like a Chernobyl.
Yeah. And it could be something that could take decades or longer to recover from. And so I just think that particularly my generation, the one that's benefited the most from this, needs to take responsibility and take action. But again, a lot of my generation didn't really understand or still don't understand what's going on. But the vast majority of people, like I said earlier when I explained this to, at first they don't like it. Oh, really? But they very quickly get it and they understand. And they say, you know what, Paul? Honestly, I never thought about it like that. And you're right. I get it. And they'd be willing to see the price of their home go down. Now, doesn't mean they're going to like it, but they'd be willing to see it happen. And I would love to see the price of my home go down, not just for the sake of the price going down, because it would mean that, nationally or whatever across our country, that younger people could start to actually dream about being able to buy a home, as they should, because of all the work and effort that they put in.
Right.
Yeah.
Well, you said a home's not a productive asset. So it kind of reminds me of pirates. They get this treasure and they go bury the treasure and their minds are rich, but it's not a productive asset at all. So if it's not a productive asset, what you're saying is it has no value.
Well, it has value. Like a home has value, but the value of the home is when the home is actually created. Like you've created capital in the form of a home. And so if I'm willing to, let's say, pay $400,000 for a home. So a builder creates capital, and then I'm making suits, let's say, and I make enough suits such that I can now buy that home from the home builder. So I'm exchanging effectively all the suits that I produced over the years to the home builder in exchange for that home. So we both produce capital, suits, and a home, and we exchange them with each other. Right? So they're both worth something. But that capital in the form of a home should not be increasing in value, right? So now let's say I borrow money, I take out a mortgage to buy that home. So I've got, let's say, a $350,000 or a $300,000 mortgage. I made a 25% down payment. Now I pay off that mortgage. Now, the way a home should help provide for your retirement is by paying off the mortgage. So when you take out a mortgage, it's like a forced savings plan. And that's the beauty, actually, of a mortgage. For a lot of people, if they're not forced to save, they won't.
Yeah.
They'll spend it. But with a mortgage, you don't have any choice. You have to pay off the mortgage. Otherwise, the bank might come and take your home, at least here in Canada. So you pay off the mortgage. Every month you set money aside. And then eventually you pay off the mortgage. And so now your home is paid off. Now, so if you make bikes, in order to pay off that mortgage, every month you have to produce a couple of bikes, sell the bikes for money. So now your bikes are effectively stored up in that money. You use that money to pay off the mortgage. Now the mortgage has gone down. The equity in your home has gone up. Essentially what's happening is your house is storing up all the bikes, the capital that you produced. So when it's finally fully paid off, so let's say it's still worth $400,000, what that represents is $400,000 worth of bikes that you created, that you built and you sold to other people. That's why you have a nest egg in the equity in your home, because you produced all those bikes, not because the central bank drove interest rates to zero and drove the price of your home from $400,000 to $800,000. So now your home is effectively storing up twice as many bikes as you actually produced. I did a podcast last week, and the guy, he read my book. And
sorry, I didn't read it.
No, it's all right. I should have sent you the watermark copy, but he read it and he said, he loved it, and he agreed with everything I was saying in the book. But he did say, I said, I have to admit, Paul, that at times it was emotionally hard reading what you were saying. Your message at times was hard to take. Not that it wasn't true, but it was hard to admit, hard to realize. And I get it.
It's kind of like being a good friend.
Well, yeah, exactly.
Sometimes you got to tell people what they need to hear, even if they don't want to hear it.
Well, yeah. And, I was going to say it's for their own good. And in some cases, it's not. They will tell you it's not for their own good. It's for the good of the next generation. And ultimately, I think it's for our own good too, because the world's just going to get increasingly divided, and it's not going to be much fun if we continue on this path. And I don't want to sort of overplay it or sound sensationalistic, but people are already very angry and frustrated. And it's not enough for us just to get on with our own lives because we can't directly see what those people are going through. And eventually it will come back to bite us, unless you're fortunate to die before the Hunger Games, scenario comes to be. But yeah, no, I think it's just the right thing to do. That's all.
Well, everyone has a lot to think about. Thanks for coming on, Paul. We'll see everyone next time.